Well, Zero Hedge has what I think is a very important article out today about the bond market and the continual tug and pull between the Treasury and the Fed going on right now. The Fed, as we all know, has been pumping unlimited amounts of money, seemingly unlimited, into the markets, trying to prop up not only the Treasury bond market, but also the corporate investment grade bond market, and now even the junk bond market. And so back in, I guess it was in March, the Fed was doing all of their even crazier than usual levels of QE, the absolute record days every day, like $75 billion a day in QE. And they did something like double their balance sheet. We're getting up there close to 10 trillion at this point. And so I've been warning that since the Fed announced that there would be QE infinity, that the federal government was going to probably do some sort of UBI type of program to try and help people during this whole Wu-flu pandemic, in which the government has told folks that they're not allowed to work, at least state governments are. And so the federal government was going to come in and just give everybody welfare to pay their bills and get by. And I've pointed out, as other people have been doing, that, well, if you just give people more money when they're not producing anything, if you replace their income without replacing their production, well, then your money that's how you actually create inflation, and that's how you actually devalue your currency in an absolute sense, and not just a relative sense. People have become, in this country especially, very arrogant when it comes to inflation, thinking that, inflation just can't happen here because the Fed has, printed so many trillions of dollars and it hasn't done anything to consumer prices. And I've explained why, for one thing, it gets sucked into equity prices. And also, if production is increasing at a faster rate than the increase in the money supply, even if it is evenly distributed throughout the economy, prices are not going to go up much, if at all, because you're having increases in production. Supply and demand are not are not changing in any relative sense. Demand is not increasing against a constant supply. Well, in this case, what the federal government is essentially trying to do with their helicopter money strategy is make sure that demand in the economy doesn't collapse much because of the pandemic, but supply is going to go down, I wouldn't say near zero, but certainly the supply in the economy, the supply side, is getting absolutely obliterated. And so if supply is wiped out and demand is somewhat stabilized, well, then you're going to get a lot of inflation. But this Zero Hedge article, I think, is interesting because it takes a look in sort of a more short-term sense at the other side of that, which is the the deflationary risk, which I think is also very real. It's a different kind of risk. Whenever you have crises like this, deflation and inflation are often two sides of the same coin, and we're talking about different things when we're talking about the risks of deflation versus inflation. When I'm talking about inflation, I'm talking about consumer prices. When in this article, Zero Hedge is talking about, I don't think they use the word deflation, maybe even, but they are alluding to the deflation of asset prices, which is a very real risk. And I have great reason to believe that consumer price inflation and asset price deflation are going to go hand in hand. So what exactly do they see coming down the pipe in this article? Essentially, there are now multiple big investment banks like Goldman Sachs or firms like Guggenheim pointing out that there's that the pace of QE that the Fed has slowed to something like $30 billion a day is not enough to take up the slack in all of the new debt that the federal government is expected to issue this year. The Guggenheim Partners is forecasting that the U.S. government is going to issue something in the ballpark of $5 trillion in new debt this year. A $5 trillion deficit would, of course, be totally unprecedented in American history, which I think everything right now this year is unprecedented in American economic history or the economic history of really any country. But the Fed's QE program is on pace, I believe, only to buy up something like $1.5 trillion. And even if you include all the other central banks in the rest of the world that also buy up, U.S. government debt, they, putting all that together is only going to come to something like $2.5 trillion, I think. And so you're going to have, well over $1 trillion at the very least dollars in new treasury bills hitting the market that Wall Street is going to have to absorb somehow, that investors in the private sector are going to have to buy up. And so what people are realizing now is that, well, if we have this massive surge in new public debt hitting, the markets without that backstop from the Fed, this is bonds hitting the market beyond what the Fed is buying. Well, then the only way that those bonds are going to clear the market is at some higher interest rate. They're not going to be able to clear at the current absurdly low interest rates. And so the immediate effect of this is that at some point this year, there's going to be, a rise in interest rates, which is going to essentially divert capital from higher risk assets into lower risk assets, because that whole risk reward calculus has changed. You will be able to get the same return with less risk, and so people will de-risk. And if that happens, well, then you're going to get asset price deflation. It's not just the value of treasuries that's going to go down because there's more treasuries in the market. If the value of treasuries goes down and treasuries become a better deal, well, then people are going to buy treasuries and sell their other assets, and then the same thing is true all down the chain. If you have an asset that's yielding, it's currently yielding 5%, and the yield on that goes to 6%, but the yield on a less risky asset that was yielding maybe 4% before it goes to 5%, you might sell your higher risk asset and buy the lower risk asset. And this is just naturally how markets work. And so we are going to end up with asset price deflation. And so the next step here is that, well, what's the Fed going to do in this case? If the Fed's QE is not enough to stop everything from blowing up, because of course once the selling starts, it's going to cascade, because that's how the nature of bubbles. When the air starts to come out, if left to its own devices, it's going to completely deflate and collapse. And Powell has made it clear that he has no intention of letting that happen. He doesn't want any other recessions in his lifetime. And he very begrudgingly, still stubbornly, a few weeks ago, refused to admit that we're going into a recession now. He certainly would never use the term depression. And so naturally, one would expect that if this happens, the Fed will, come back to the rescue and try to save the markets by rapidly or massively increasing QE to try and compensate for this rise in interest rates. Because of course Powell has said that the government has QE unlimited. Whatever debt the federal government issues, the Fed will make sure that they are able to fund that, and that the federal government essentially doesn't have to worry about deficits. Powell said now is not the time to worry about the deficit. But right now, it's seen as, he's not able to just start increasing QE without a reason. They need a justification, is the case that that Zero Hedge is making here, which is true. Powell always waits for some sort of crisis that he can use as an opportunity to expand what he's doing. And depending on how you look at it, that's either a calculated way of him just looking for an excuse to do what he wants, or he just doesn't see these things coming and he's purely a reactionary thinker. Either way, all the signs point to a coming reckoning for the bond market in the short term before the Fed comes out full guns a-blazing and decides to buy up everything forever, which, again, they already said they were going to do that, but after they came and saved the day back in March to stop that, to put a floor in the market at, S&P 2200, something around there, they started to taper off that massive QE. They have not kept it up. But yet the Congress keeps passing more and more of these multi-trillion-dollar spending bills. Of course, the House just passed that $3 trillion spending bill last night that seems to be, it seems to have voted on partisan lines, so shouldn't make it through the Senate. And even if it did, it should be vetoed by Trump, from at least the analysis that I've seen. But again, I try and stay out of the political sphere largely and stick to the financial stuff. But even if this $3 trillion bill is struck down, another one will be brought up, and there will just be more and more of these. Because think about it. So far, these spending bills have been targeted at all of Washington's cronies and all the lobbyists and things. And actually, it's pretty funny. This $3 trillion spending bill, not to get off topic, actually has within it a bailout for lobbyists. And so ordinary people haven't been bailed out yet. We haven't seen what I've been talking about with the helicopter money, with the ordinary people getting their UBI to replace their income. That hasn't happened yet. This is all still speculative. But I'm expecting that it will have to happen because, people are going to be pissed that, again, all of DC's friends, the lobbyists, Wall Street, everyone there got their bailout, and ordinary people didn't. You're going to get riots in the streets if people don't get their pound of flesh. Of course, even without all this UBI stuff, if the federal government just spends all this stuff, even if it doesn't create inflation, it will ironically create a lot of asset price deflation. If the Fed is not there to monetize the debt. So yes, Keynesians, government fiscal stimulus can be deflationary. If all you're looking, if all the inflation that your economy relies on to continue growing is in asset prices. Of course, if you ask me, just using a printing press to inflate the value of anything is. Let's just say that it goes against market principles, and it is not a sustainable way of growing anything because the value is not going up for any real reason. It's just going up because of accounting tricks, basically. So I'll link the article below. I think you should give it a read if you're interested. But that's all I have to say on it for now. So if you gain anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe because I do upload every day, and I'd hate to have you miss one. So I'll see you folks back here tomorrow.